Thank you for joining us. Today's topic is going to be about credit scores. So I get, oh my gosh, every day I get a question on Maria, how come whenever I go onto this website, my credit score says it's one thing, and then I go apply for a mortgage loan and it's like 30 to 50 points different, sometimes higher, but most of the time lower, unfortunately. And also, if I go to Credit Karma, my credit scores are different on that website. So I go to Experian.com and my credit score is different on that website. So it's very, very confusing. And so I thought this would be an excellent topic to talk about today. So, first and foremost, we have multiple credit scores. Yes, we have three major credit bureaus, which are TransUnion, Experian, and Equifax. And so all lenders, every lender pretty much uses either one of those three. Typically, when you apply for like a credit card or something like that, they're only going to generally pull from one credit bureau, and it just depends. Every bank pulls from one or the other. Typically, the only time they're gonna pull all three credit bureaus when you apply for something is when you apply for a mortgage loan. Even an auto loan, they'll typically pull one credit bureau, and then if they can't get you approved because you don't have the best credit, then they'll send your application to a whole bunch of different banks, and that's why you end up having so many inquiries because each bank uses um, a different credit bureau. So either TransUnion, Experian, and Equifax. So mortgage loans, they're going to pull all three, and they're going to go off of what they call the mid score, which is the middle score. So not your highest score, not your lowest score, but the score that's in the middle. So if you have like a 550, a 620, and a 700 credits on each credit bureau, they're going to use that 620, which is your mid score, the score that's in the middle. Um, so that's really important to understand that. Now, the reason we have so many different scores and why we go to so many different, when you go to so many different websites, your scores vary. It's because the algorithms that are used when you're applying for specific types of loans. So if you're applying for an auto loan, for example, they're more concerned about, have you had any auto loans before? Is this going to be your first time buying a car? Even if you've had a cash car, unfortunately, that doesn't report on our credit. So if you've had a cash car in the past, when you go apply for an auto loan, it looks like you may have paid for that car for 2 to 3 years, and you got it from one of those buy here, pay here kind of places, and most of those places don't report to the credit bureaus, or they'll report to maybe one bureau because they do all their financing internally in-house. So you always want to go and try to get a auto loan that's going to report to your credit, because that payment history is very important. Because if you go in and apply for an auto loan, even if you've been paying on time for 2 to 3 years, you're not getting any payment history reported to your credit. So then whenever you go apply for an auto loan again, and they use the algorithm looking for, have you had any auto loans in the past? Do you have any repos on your credit? What was your payment history if you did have an auto loan? Were you paying on time? And so they're going to weigh those types of loans more heavily when they're calculating your credit score, because you're coming to them asking them for an auto loan. So they're specifically interested in what your auto loan history is, which is why your score is going to be different. If you apply for a credit card, they're going to look to see, do you have other credit cards? Have you been paying them on time? Is your utilization really high? And that's going to factor into that algorithm differently, because again, you're applying for a credit card, so they want to know, did you go on a shopping spree and you got all these credit cards and you still owe all these companies, and now you're asking me for a credit card. So yes, your score is going to be different based on your current and previous credit card history. With a mortgage loan, they use the most outdated scoring algorithm. I believe it's FICO 6 right now that they're using. And so your credit score is going to be different when you apply for a mortgage loan, because they're looking at overall. Do you have any positive credit history? Because if you don't have any credit history, if you're paying cash for everything, it's not reporting on your credit, and so the bank is going to consider you a high risk because they don't know how you're paying your bills. They don't have, they can't call your previous rental. If you're paying rent in some apartments, unfortunately, the only time apartments goes on our credit is if we owe them money when we move out, or if we're evicted or something like that. But most places, they don't have your payment history, rental history reporting to your credit, and if they do, like the Experian Boost and things like that, it's actually not factored into your mortgage FICO score. I know that is so confusing, but that's why Experian Boost does not really help us. I'm not going to say it doesn't work because it can work when you're applying for certain types of credit cards. But Experian Boost, if you're trying to purchase a house, and even trying to get an auto loan, it's not gonna help because they don't really want to know, were you paying your bills on time as far as cell phones and electricity and things like that, because that's ultimately what Credit Boost is. Credit Boost allows you to add like Netflix and your utility bills, your electricity bill, and things like that to help boost your scores. But that is FICO 10. And so when you go apply for a mortgage loan or an auto loan, they're using like FICO 6, 7, or 8. And so those accounts are not going to be considered into the math when it's calculating your credit score, because they know, when you're trying to apply for a house, they're wanting to know your overall, how have you been paying your bills in the past, generally, not like just specific auto loans or specifically credit cards, but overall, do you have at least 3 or 4 open lines of credit? Have you been paying on time for at least 2 years? Is your credit card utilization below 10%? Because if you're maxed out on your credit cards, you're probably already over budgeting. You're already in over your head, and I'm not able to afford the current bills you have now because you're having to survive off your credit cards. So they're looking at it from a general financial aspect, and your credit gives them basically a picture of what your financial situation is for that time period. And for the last couple of years as well, because they want to know, are you able to manage the debt, the bills you have now? So that's why your mortgage score is more important or different than your, trying to apply for other types of credit. And then they use the older algorithm because honestly, like Experian Boost, I know we're going to just keep talking about that, but those types of credit accounts that you're adding for Experian Boost, the reason they're not taken into consideration is because if you don't pay your cell phone bill or your electricity bill or Netflix, like, guess what? It's going to get cut off. So most people are going to pay those things on time. So the mortgage industry does not consider that as a way to determine if you're managing your debt or paying your bills, because most people are going to pay those immediately because there's a immediate repercussion if you don't pay it. If you don't pay your cell phone, your electricity, water, Netflix, any of those, you only have 1, maybe 2 months before that service is cut off. And so that's not going to be considered a way to determine your financial health, as opposed to if you have an auto loan or a credit card. You can go 2, 3, 4 months without paying those things before they're closed and charged off. And and most people, if they run into a financial bind, they're going to immediately stop paying their credit cards first or their auto loan first. But unfortunately, we typically keep our cell phone, we pay our cell phone and our electricity and stuff like that on time because we are forced to. We have to. So maybe that helps as far as, trying to determine if you're trying to buy a house, basically, don't even look at Experian Boost. That's not necessarily, again, not a waste of time, but it's going to make your score look a lot higher than it really is. Okay, so I did have some sort of, I was going to try to get an example of somebody, like I have a client that's in the program, and I had her pull her credit reports on Credit Karma this morning, and her credit score on there, she said, was a 762 for TransUnion. And so I had her pull her regular credit report because she's applying for a mortgage loan, and her mortgage loan credit score was a 783. So in that aspect, it was not too bad of a difference. It was about a 20-point difference for the same credit bureau, which was TransUnion. Equifax was also about, I think, 32 points difference. So there were about a 20 to 30 point difference on this very same day. She had her credit score pulled or refresh her credit reports on Credit Karma, and then we also had the mortgage lender pull her credit today as well, because we wanted to see, what factors are going to be different. So hers being different, only 20 to 30 points, is actually not bad. That's about average. But I have had clients who will go and apply for, they'll refresh their credit reports on Credit Karma, and they'll go and they'll tell me, Maria, it says on Credit Karma I have a 650, so I'm going to go ahead and go apply. And I'm like, no, because I'm on Credit Karma it's a little different, so your scores are probably going to be about 30 to 50 points lower. And so sure enough, they'll go and apply for a mortgage loan, even though I recommended they wait because I saw the factors on their credit score that weren't being considered on Credit Karma. And so they'll go and apply for the mortgage loan, and sure enough, their scores will come back in the 500s. I mean, I've seen the difference be almost 200 points. So just keep those things in mind. I know, again, it's very confusing. So if you have specific questions, let me know and I'll try to address them the best I can. I'm not going to go into it, gets more confusing when I try to explain it as, oh, you have FICO 10 and FICO 6 and FICO 7, 8, and 9 or whatever. I mean, those are the different scoring systems that the different banks do use. But it's more important for you to understand, depending on what type of credit you're trying to apply for, it is important for you to know, okay, if I want an auto loan, these are the things I need to focus on, because even if I have a 700 credit score, but on, Credit Karma, if I have a repo, when you go apply for an auto loan, be prepared, your score is going to be probably 75 to 150 points less, because your auto loan score is going to be different from your Credit Karma score if you have a repo, okay? If you have an auto loan, a mortgage loan that you're trying to apply for, I have a website, and I'll share that link with you after the Facebook Live. I'll post it on my bio and on the comments. So we use a credit monitoring service called MyScoreIQ. You can go directly to their website and register if you'd like, but it's going to charge you more. I believe it's $38.99 a month. And it gives you all your different credit scores. I believe it gives you 6 different credit scores, but it's going to give you your auto loan credit score, your mortgage loan credit score, your credit cards credit score, your Vantage Score credit score, which is what Experian Boost uses. So that way you can kind of just see how your scores vary. So that if you use the link, it has a discount on there where it's $30.99, so it saves you $8 a month, and you'll still get those same benefits. So without having to pay the extra $8, it's very much worth it if you're trying to get a home or trying to get your credit together. To even more importantly than just trying to buy a home. I have clients that can't get a job because of their credit. So everything is just more more dependable on our credit. Just the world is just getting, worse as far as judging us or whatever, not determining our self-worthiness off of our credit scores, which is very unfortunate because especially with, COVID, a lot of people did lose their jobs or lost hours and things like that. So it's been a real challenge. And instead of the banks trying to be on our side, it's like they're making it harder because there are so many people that are trying to buy houses right now. It's almost like, okay, if you don't have really good credit and somebody else has really good credit, then yeah, they're going to take that other buyer over somebody that doesn't have the best credit. And if you're going to pay 10-15% over the asking price. So it's just getting worse. Next week we're going to talk about medical bills, medical collections. They did just pass some laws, and I've had a lot of questions about that. So effective July 1st, there's going to be some changes about medical bills and how those affect our credit. So we'll talk about that in 2 weeks. So that is, what is that date? So on Friday, May 6th, we will talk about medical collection, same time, 12:30. But again, I will share that link with you. My 15 minutes is just about up. I try to keep these very short so that people can watch them at their own time. And please subscribe. It'll be on our YouTube channel. If you don't have Facebook, I'll make sure I share it on my YouTube channel. Just YouTube, kcmsfinancialgroup.com. I've got several videos on there that talks about the different topics that I think are extremely beneficial for just basic consumers like ourselves to understand. And if you subscribe to my channel and tag 2 people, you will receive a $25 credit if you decide to use our services. And for every person that you refer, keep in mind, and every time you refer somebody to our program, if they start the services, you'll also receive $25 off. A $25 credit. So you can really, if you know enough people that need credit repair and need a good, credit repair company that's going to be helping them and guiding them, that's what we do. We are credit repair and education. It's really, really important that I educate my clients and everybody on how to build their credit using the right strategies. Don't go get 10 credit cards because that's what the banks want you to do. So it's a method to all this madness. And so I would be more than happy if you want a credit evaluation, even if you don't feel like you need credit repair. The credit evaluations is just an opportunity for me to have a 15-minute talk with you to go over your credit, give you some guidance. If you just can't reach that credit score you're trying to achieve, or if you're trying to fix your own credit and you just need some help understanding what you can do, what processes to take. Do not dispute online. That's not credit repair. But I'll be able to take a look at your credit to see if you qualify for the program. If you don't qualify for the program, I'll be very honest and let you know up front, hey, you don't need credit repair. You just probably, if you do these few things here, that'll help boost your scores, or whatever. So it's not an obligation for the program, but we can schedule that time if you'd like, and I'll also send that and put that information in the comments. But it was a pleasure talking with you guys today, and I look forward to seeing y'all in 2 weeks.